Country-to-country revenue comparison. Hello and welcome to CandiMentor. Today we break down how revenue works across countries. The real-world differences that matter in interviews, audits, cross-border deals, and global reporting. We'll move slow, clear, and practical. By the end, you'll see how 4 ingredients shape revenue across jurisdictions: the accounting standard, the indirect tax system, the regulatory environment, and the industry landscape. The accounting rulebook, what each country follows. You can only compare revenue across countries if you know which standard is used. United States, ASC 606. The 5-step model. Identify the contract. Identify performance obligations. Determine transaction price. Allocate. Recognize revenue when control transfers. IFRS countries. IFRS 15. Used in the UK, UAE, Canada, Australia, South Africa, Europe, and most of Asia. Same 5-step backbone as US GAAP. Slightly different wording, but aligned in spirit. India, INDAS 115. Same as IFRS 15, but with Indian application guidance. Canada, private sector, may use ASPE with different revenue models, but listed companies follow IFRS 15. Main message: across most of the world, revenue rules are the same, IFRS 15. The US uses ASC 606, which is almost identical. Indirect taxes, where countries differ the most. Revenue may look the same across countries, but taxes change the invoice and the way revenue is presented. VAT countries: UK, EU, UAE, South Africa, Australia, Singapore. VAT is added on top of the selling price. Revenue is recorded net of VAT. GST countries: Canada, India, Singapore, Australia. GST also sits on top of the selling price. Revenue is recorded net of GST. Sales tax countries: United States. Sales tax is added by the state or city. Revenue is recorded net of sales tax, but rules vary by location. Why this matters? VAT, GST countries have national rules. The US has state-by-state variation, which complicates software, subscriptions, and e-commerce. Corporate tax rates. How after revenue profit changes. Corporate tax shapes pricing and revenue strategy. High or mid-range corporate tax countries: UK, Canada, Australia, South Africa, India. These countries have headline rates in the low to mid-20s or higher. Lower corporate tax countries: UAE, Singapore, some special zones in Asia and the Middle East. These regimes often use low tax rates or free zone incentives. Medium corporate tax countries: United States. Federal plus state gives a mid-20s combined rate depending on geography. Takeaway: revenue accounting is the same, but profit after tax differs widely across countries. End. Regulatory environment. How strict each region is. United States, very strict. The SEC expects detailed revenue disclosure. Performance obligations, variable consideration, and contract testing are heavily monitored. United Kingdom, detailed and documented. The Financial Reporting Council expects clean, transparent disclosures under IFRS 15. UK audits challenge timing of revenue, especially in services and construction. United Arab Emirates, compliance plus tax focus, IFRS 15 for accounting. Strong emphasis on UAE VAT rules and free zone qualification. Cross-border contracts are reviewed carefully. Canada, dual oversight. Securities regulators look at revenue quality. Tax authorities review GST, HST compliance. Banks and insurance companies face additional disclosure requirements. Industry mix. Why revenue feels different country to country. United States, large SaaS economy, subscription services, telecom bundles, streaming, and state-level taxes. Common issues: multiple performance obligations, complex licensing, usage-based variable consideration. United Kingdom: strong consulting, financial services, and international trade. Common issues: service over time revenue, cross-border VAT rules, contract modifications. UAE: logistics, real estate, contracting, technology, and free zone structures. Common issues: long-term construction revenue, milestone payments, VAT treatment for exports and digital services. Canada: resource-heavy economy, oil, gas, mining, forestry. Common issues: commodity-linked pricing, long-term contracts, seasonal patterns, regional GST, HST differences. Each country applies the same rules, but industry patterns shape how judgment is applied. Numerical examples: how revenue appears on the invoice. Example A: UK VAT, 20%. Selling price £1,000. VAT, £200. Invoice, £1,200. Revenue recognized, £1,000. Example B: UAE VAT, 5%. Selling price AED 10,000. VAT AED 500. Invoice AED 10,500. Revenue recognized AED 10,000. Example C: US sales tax, varies by state. Selling price $1,000. Sales tax $70. Invoice $1,070. Revenue recognized $1,000. Example D: Canada GST HST. Selling price CAD 5,000. GST HST CAD 650. Invoice CAD 5,650. Revenue recognized CAD 5,000. These examples show how tax affects invoicing, not revenue timing. Cross-border revenue: hidden problems companies face. When companies operate across multiple countries, these issues arise. 1. Different tax laws. VAT, GST, and sales tax rules conflict. 2. Different contract laws. Some countries rely on formal contracts, others accept purchase orders. 3. Multi-currency billing. Exchange differences affect revenue, contract assets, and variable consideration. 4. Transfer pricing. Intercompany revenue must be arm's length. Accounting revenue doesn't equal tax revenue. 5. Permanent establishment rules. Delivering services in another country may create a tax presence. Interview cheat lines. Say these slowly. Most of the world uses IFRS 15. The US uses ASC 606. Both follow the same 5-step model. Big differences arise from VAT, GST, and sales tax rules, not the revenue standard itself. Industry mix shapes revenue judgment. SaaS in the US, services in the UK, construction in the UAE, and resources in Canada. Revenue recognition may be identical, but taxable revenue often differs by country. These lines instantly make you sound senior. Quick global checklist. Use this when working on revenue across countries. 1. Identify the accounting standard. IFRS 15 versus ASC 606 versus ASPE. 2. Check whether prices are tax-inclusive or tax-exclusive. 3. Determine performance obligations country by country. 4. Understand the indirect tax rules, VAT, GST, sales tax. 5. Map cash collection and discounting rules. 6. Ensure disclosures satisfy the local regulator. 7. Reconcile accounting revenue versus tax revenue. Final wrap. 1-paragraph summary. Across countries, the revenue model is almost identical. The 5-step approach dominates globally. What changes is everything around it. Indirect taxes, regulator expectations, industry patterns, corporate tax rates, contract laws, and cross-border complexities. If you master the standard plus the local environment, you can explain revenue anywhere in the world. If you learned something today, subscribe to CandiMentor. We're building the world's best learning hub for accounting, finance, and interviews, and you should be part of it.